it's looking potentially unlikely at this point. My hypothesis would be that it's going to be difficult for them to achieve their goals.
Hi, Tessa. Lovely to meet you and excited to be casing with you today. We have a kind of phone case here, and we can jump right in if that works for you.
Perfect. Great to meet you too, and I'm looking forward to it.
Fantastic. Okay, so our client is HMD, a phone manufacturer known for producing mobile phones that serve a range of carriers. The company is considering launching a new line of feature phones in the US aimed at consumers that want to escape internet connectivity on their phones, the constant, access to the internet. Feature phones are basic mobile phones that offer just essential services like calling, texting, and lack the advanced capabilities of a smartphone. So just think back to the old flip phones, etc. Um, and HMD needs your help to decide whether this new venture is worth pursuing. How would you go about evaluating the feasibility and profitability of this new product line venture?
Perfect. That's really exciting. And I know that there's a big trend for people disconnecting. I didn't know people were taking it this far, but I'm excited to dig in and learn sort of how many people are getting into this trend and learn a little bit more about it. So to start off, I'm wondering if you can tell me a little bit more about the client's goal. You mentioned that they're just looking at sort of expanding their revenue, but do they have a specific target that they want to reach? Is there a certain amount of profitability that they'd like to have within that?
Great question. So the primary goal for HMD in launching this new line of feature phones is simply to diversify their product lineup and tap into this niche market segment that seeks this basic phone functionality. Separately, financially, they have set targets for 3 years post-launch. They would like to hit 40 million in sales and hoping for a 20% profit margin.
Great. Okay. And then I'm wondering if you can tell me any more about which customers would HMD target with this sort of new initiative. I'm just curious, like what sort of segments of customers are looking for this type of offering?
Yeah, fair question. So really, these phones sort of target three demographics. One is seniors who really just aren't familiar with the smartphone, etc. They just want the basic phone. The second is parents who just want a simple phone for their children to be able to call, text them as needed. And then the third bucket is adults looking to limit their connectivity. And basically, they don't want to be always on anymore. And so, getting the basic phone prevents them from always checking their smartphone, etc.
Perfect. That makes sense. And then finally, does HMD have any experience in creating these types of phones? Do they have like operational capabilities that are already set up for them? Or is this something they'd need to sort of figure out whole new manufacturing lines, supply chains, like go through an R&D phase? Where are they at in terms of like being able to offer this product?
Another great question. So HMD has typically produced smartphones, and so this line of feature phones would be an entirely new product. But operationally, HMD has existing manufacturing infrastructure and supplier relationships for phones that can be utilized for the production of these feature phones. And so they're probably fairly well equipped from an ops standpoint to launch this new product.
Perfect. Thanks so much. At this point, could I take a minute just to sort of structure my thoughts around the case?
Of course.
Perfect. Thank you. Perfect. I'm ready. There are four different buckets that I would like to look at when sort of analyzing this case. To start off with, I'd love to learn more about the target market and the target demographic of people that we'd like to target. So I heard sort of your answer about the different groups of people, but I'm trying to understand, are there certain market trends or forecasts beneath that that can help us better understand which of those segments might be growing or if there are any new segments that might sort of come into the market. Next, I'd want to really look and drill down on that segmentation and really understand like which one is most critical if we were to just go with one of them or which ones share similarities between the segmentation. And then third, to understand consumer preferences. So are there particular features that some of the segments or target demographics really like? Is there something in particular that we should be understanding about the purchase patterns or the frequency of purchase that people have when they're buying these types of phones? So that's the first bucket, which is about the target market. The second bucket is about the company capabilities. So really understanding like more, digging more into those partnerships that you mentioned, understanding the manufacturing capacity and understanding the product and marketing that would be required by the company to really get and distribute these products. And then putting those together, really assessing what the total opportunity of this new offering would be. So making revenue projections, understanding the profit margins, and then understanding the investment. You had mentioned that they really want to have a 3-year payback period. So depending on what the investment would need to be, what the marketing and sales would need to be, understanding if that's possible. Finally, if all of those check out and we think the opportunity is big enough, the fourth bucket that I'd want to look at is really what is the implementation of a go-to-market plan? How would we actually take the product to market? When would we take it to market? What would be the key risks? And what would be the next steps that the company should follow?
That
Does that sound okay?
Yeah, that framework sounds perfect and makes a ton of sense. And so kind of starting here, I think assessing the target market with your first bucket is kind of where, I think we're going to start and where the client wants us to dive in first. And so just for some background here, the feature phone market makes up only 6% of the US cell phone sales in a given year. And so they would like us to estimate the current size of the market for feature phones in the US, given that information.
Okay, got it. I'm actually surprised that it's as large as 6%. So that's really interesting. Perfect. So when trying to understand really the market size, what I would want to do is take the US population and then understand sort of if we think about that 6%, what percentage of the population actually does have this type of phone. And then from there, just because someone has that type of phone, it doesn't mean that they're buying one every single year. So drilling down to like how often they would purchase that or how frequently they would. Does that sound like the best methodology to sort of go after understanding what the market size for this would be?
That sounds perfect. Yep.
Great. So if we can assume there are about, let's say, 330 million people in the US, is that an okay estimate?
Yeah, that's a great estimate.
Perfect. And then from there, we would say, not everybody is old enough to have a phone, even though we're targeting children with this. Let's say there's some people who might be like infants that don't need a phone. So if we round that down to 300 million people who would really be in that target, so we say 300 people who are old enough to have a cell phone. And then let's say people on average get a new cell phone once every 2 years, maybe because they're trying to upgrade or because their phone breaks for whatever reason. Does that sound like an okay assumption, or is there a different sort of time period that you'd suggest I use?
That works. Perfect.
Perfect. So if we take that 300 million and we multiply that by 50%, we get 150 million new cell phones are sold per year in the US. And then we just need to multiply that by the 6%, which you mentioned was the number of people who have this type of phone. And that's 9 million feature phones that are sold each year. Does that sound about right?
Yeah, that sounds right. And so if you were to assume just a price of $50 per phone, what's kind of that market size in dollar terms?
Yeah, great. So 9 million phones times $50 per phone, 9 times 5 is 45. So that would be 450 million per year, which at first glance actually seems like quite a small market size. I guess that's because that $50 price point is quite significantly lower than, say, like the brand new iPhone that came out. So it's like a fairly small market size, but would love to dig more into whether HMV feels as if they might be able to get to that 40 million in target that they're looking for.
Yeah, that's a great commentary on it's just much smaller. If you think about, Apple's, market cap, or if you think, I know, an Apple store does about 200 million of sales per year in each store. So when you think about the total market here, it is small versus, the market for smartphones. And so, based on this, there's a follow-up question from the client, and they want to understand, the growth rate implications on the feature phone market for the market 3 years from now.
Okay.
So a follow-up question for you is the current feature phone market is declining at a rate of 5% per year, but some forecasts expect the feature phone market to grow at 5% per year, and others expect it to just be flat. And so the client has a question for us, which is, given these three growth rates, what would be HMD's, or estimate the size of the market for feature phones in the US in 3 years, given these three different growth rates. So basically, what will the market look like in 3 years when HMD wants to hit their goals, um, is what they're hoping to get here.
Perfect. So it sounds like what we need to do is really understand what the range could be between these different estimates. I think it's pretty funny that the growth estimates are so wildly different. It can kind of go in any direction. But if we calculate a range, then we can better understand what the various scenarios would be. So I always like to go with sort of calculating the positive scenario, the growth scenario. So what I would do is sort of take that 450 million, and then I would need to figure out for 3 years from now, at a growth rate of 5% each year, what that total growth rate would be in 3 years. So to do that, I would actually say 1.05, so 105% to the power of 3. So 1 plus 0.5 plus 0.5 plus 0.5. And then I'd multiply that by the original 450 base case. So if I had 450 times 1.15, and this is where the math gets a little bit tricky, but we have 450 million plus 45 million, and then plus 3 over 2 times 3 over 2. So that is actually 45 million is 10% of 450 million. So we get 450 million plus 70 million. So the growth part is the 70 million, and then we're adding that to the initial. Does that sound about right?
Yeah, that works.
Okay. And I know there's a little bit of rounding to estimate there, but that's 520 million in total. So that's for the upside scenario. Then for the downside, we don't have to do all that multiplication again. It's the same minus 5%. So what we can actually do is just subtract that 70 million from the base case 450 million, and that will get us about 380 million. So that would mean that the range is between 380 million and 520 million in terms of the market size in 3 years.
Yeah, that makes a ton of sense. And again, just given the negative growth expectations and the flat growth, it could be smaller than the already small market size that we're thinking it is now. So this is not a booming, growing, large market. This is, a niche market that HMD would consider entering.
Yeah, exactly. And I just add, like, again, trying to compare that to the 40 million, in the case where it's 380 million, that's like quite a significant size. It will depend on what the competitive environment is, but to expect to launch a new product and in 3 years have, 10% or more market share, that is a pretty ambitious goal. And so it's looking potentially unlikely at this point. My hypothesis would be that it's going to be difficult for them to achieve their goals.
That is a really fair point. And so based on this work, the client has realized that this original 40 million revenue goal seems unlikely. And instead, they've decided to lower their initial investment and revenue goal. So the company now believes that with a $12 million investment to sort of stand up this venture, they'll be able to sell 200,000 phones per year. Assuming a per unit cost of $35 and a sale price of $50, what will the company's annual revenue be, and how long will it take for them to pay back that $12 million initial investment?
Great. Okay. So for this, the math should be pretty easy. We'll just take the price per phone and we'll multiply it by the 200 units that they mentioned, and then we'll get the revenue number. So if we know that it's $50 per phone, and then we multiply that by the 200,000 units, that's actually 10 million in revenue. So as you mentioned, lower than the 40 million in revenue that they had initially thought. But this is us sort of reworking and rethinking the numbers. Then, if we think about what the actual profit margin would be there, we know that the cost is $35 per unit, and that means that they'd achieve $15 per unit in profit. And that actually looks like a pretty good figure, considering that they had initially thought and they were looking for 20% margins, and this would exceed that. So if they're right about those, $35 costs, I'm not sure what the sensitivity is on that, but if they do end up being right on that, that's one good news story. And then if we say the 200K sales per year times the $15 in profit per unit, that's actually $3 million in profit per year. Um, and does that sound about right just before I do the final calculation here? Yep. Okay. And then what we need to do and really think about there is the payback of the $12 million investment. So a $12 million investment with $3 million profit is a payback period of 4 years, which is unfortunately outside of the target of the 3-year payback that they had been looking for. Um, what I'd also just reiterate is I know that we're reworking the numbers here, but this is way less than the 40 million per year initially targeted. I'm not sure that the client would really want to downsize their target by 1 quarter. So just really thinking and rethinking about whether this is the path for them to pursue.
That's a, fair call out there. And one motivation for the client to enter this market is that HMB is in conversations with Mattel to launch a Barbie branded phone, so pink
Ooh.
fun phone. And HMD is hoping that this partnership could drive increased market share, revenue, and margin for this segment of the feature phone market in the US. And so the question for you is, how would you evaluate this partnership's impact on the decision for HMD to enter this market?
Wow, I love this twist in the case. I love any case that can bring Barbie to the forefront. But that's actually a really, really interesting proposition. And it makes me want to just take a step back and actually maybe look back towards the framework that had initially we had initially gone through. I know we've strayed a little bit. We went straight to the financial bucket. But if we just take a step back to that framework, um, I would love by sort of understanding if the Barbie partnership and the sort of the Mattel partnership would have the opportunity to save the launch per se. So first of all, the first bucket that I had proposed was the target market. And I actually think that focusing on a Barbie partnership might actually restrict the market that is addressable in this case. There might be some segment of the market, say if there were like young girls who were looking to purchase, or the parents were looking to purchase a phone for their young girls. That might be sort of a segment that completely blows up, but that seems like it would be a relatively small segment of the overall market that we had addressed. So we might be able to win a higher percentage, but it would be a smaller target overall. The company capabilities probably shouldn't be changed from our initial analysis. So it sounds like their capabilities they were able to manufacture through their partnership. And as long as that's continuing, that probably shouldn't change. And then the third question was in terms of the opportunity. And the biggest question for me is whether we would have the opportunity to increase the number of units sold, which really did seem like the biggest thing that had gone wrong. Um, so what if we sort of explore that third bucket a little bit more and try and understand what we would need to believe to think that we should go down this partnership with Mattel? Does
I
that
love
sound
that
okay?
path. Yeah, that sounds like a perfect plan.
Perfect. So if we assume that the Barbie branding could get us from 200,000 sales, let's say just up to 250,000 in sales per year. And let's also say that we could get up from the $50 per unit to the $60 per unit, branded a bit more as a premium product. It's the thing on the shelf that your eyes go to. Um, so that would increase revenue from the 10 million per year that we had previously calculated to 250K times $60 is 15 million, which is closer to the original goal. But the ratios also would reduce the payback period. So if we had the $60, so we had the 15 million, that would mean $25 per profit, assuming if we had the same costs from before, multiplied by the 250,000 units is 6.25 million per year. And then if we look at the 6.25 million in profit per year versus the initial 12 million investment, that means that the payback is in a little more than 2 years, which is actually what the client had wanted was the 3-year payback period. So actually, the partnership with Mattel does seem, if we can assume sort of those figures of the 250K, that partnership would actually mean that the client would be able to hit their sort of reassessed target that they had set. Um, I do think that the go-to-market plan would probably look different in a Barbie world. And so in that case, the client should really think about one particular segment, which is the younger girls, and really how they might be able to address that clientele in particular, whether there be maybe some commercials on like Barbie type shows, or if the phones could be sold in like accessory stores for people who might be the target demographic. Let's say something like a Claire's or something like that. So really understanding what that go-to-market strategy may be.
That is, that makes a ton of sense. Some great thoughts there. And so, concluding here, you're presenting tomorrow to the CEO of HMD. Love to hear kind of what your final recommendation would be.
Great. Yes. So the goal of the case was to understand if HMD should launch the US feature phone and enter this market. Um, I would say that the answer to the case is that it seems like it will be difficult for HMD to achieve their goals, and they probably should not pursue the launch unless they decide to go with the Barbie phone. And the Barbie phone is what could sort of save the launch. So really my recommendation to HMD would be to launch the Barbie phone, to go and segment that specific type of segment that would look for that, and to proceed with that recommendation. Still saying that it is slightly lower than their initial projections and estimations. And so therefore, what I would say the biggest risk is for them is just if the phone flops and they don't sell as many units as they expected. I think that is something for them to be aware of, and especially if the market does end up contracting and not getting as big as they expect. What I would say the biggest next steps are is to really understand, maybe through customer surveys, if there is a strong segment of the market who does want that type of product and who is looking for a Barbie branded phone. And if there is, then I think that they should proceed with that.
Great. That makes a ton of sense. Well, thank you so much, Tessa, for your time today. Was great casing with you.
Thanks so much. You too.
Hey everyone, it's Kenton Koveski here, the founder of Rocketblocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocketblocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocketblocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.